All right, good day and welcome to the Daily Mortgage Briefing. My name is LT Mortgage Advisor and the creator of the IPAC Score. And the IPAC Score is a proprietary home buyer readiness system that I developed here with the Constructive House to give consumers a transparent, easy to understand assessment of their mortgage eligibility. And what the IPAC score does, it's not a pre-approval, it's not a conditional approval, it's not any underwriting process. But what it does is it evaluates the four pillars that every lender uses to determine your mortgage approval. And that's income, property, assets, and of course credit. And the IPAC score, it bundles all of those up and it develops a readiness score for you. It's just a mortgage readiness tool. So it's not an approval, but it helps you predict what your readiness is when it comes to refinancing or purchasing a home. So if you want to check out your IPAC score, you want to see how close you are to getting that refi done or to getting that purchase done and see what you need to prepare for and how to be an informed consumer, get that IPAC score at theconstructivehouse.com. It's a very useful mortgage readiness tool, and I encourage everybody to take advantage of it so that way you can be an informed consumer. No one wants to go out there and have mortgage folks, mortgage pros, realtors talking over your head. You want to make sure you are aware and you are informed on everything that's going on so that way you can make the best financial decision for yourself, because if you don't know, home ownership is the gateway to generational income. It will be the biggest investment most Americans make in their entire life. So it's very important that you know what your IPAC is and you do everything you can to continue to strengthen your IPAC, because that is imperative when it comes to purchasing a home. That's what lenders use to determine your ability to repay the mortgage, and that's going to set you either in the approval side or in the denial side. So get your IPAC score. Without further ado, I just wanted to break down what the daily mortgage briefing is, and we'll unpack everything today. But I do like to set aside 15-30 minutes or so to break down what's happening in the market and how it affects real home buyers, so you can use strategy, not stress, to get mortgage ready. And I want to kick things off so you do have all the knowledge you need to be equipped to be an informed and empowered buyer. And kicking things off, rates today came in stable to slightly improving, with most lenders rates in this range of 6.24 to 6.4% on a 30-year fixed. Of course, that's depending on your credit, down payment, and what loan type. So it's not, me quoting an exact rate, but generally speaking, this is what most lenders are offering, is going to be in that range for today. And I like to break down what drives the rates, because we want to make mortgages simple here. I don't like talking over people's head. I don't like using jargon that you're unfamiliar with. But just to break it down, there's four key indicators that determine what rates will be, if they're going up, if they're going down, what have you. And that's going to be the bond market, that's going to be inflation, and that's also going to be the Fed and housing inventory. Those four key indicators are what drives rates. That's what's driving it. And the bond market today is reacting to slightly stronger mortgage-backed security pricing from this morning, which usually helps soften rates. All right. And mortgage-backed securities are, like I explained before, and I'll continue to explain it because we got new viewers, we got new folks coming along. And, it's always helpful to continue to go over what certain jargon is so you're familiar with it and you can use it. But mortgage-backed securities, think of it like big boxes of mortgages that investors buy. All right. No different than a box of shoes, a box of clothes, a box of what have you. Any product, mortgages are products as well. And if investors like what's in the box, rates will go down. If investors don't like what's in the box, rates go up. That's why it's important to have a solid IPAC, because the IPACs are going to determine what the mortgages look like that investors buy. If they don't like the IPACs, then the rates are going to go up because they don't like what's in that box. They got 30-year fix here, conventional, 30-year fix VA, 30-year fix FHA, and the IPACs are shaky at best, or they're weak. Rates are going to go up because they don't really like what they're seeing. They don't know if they want to invest their money into that. But if you got strong IPACs in this box of mortgages, then they like what they see. They're investing more, rates go down. That's how it goes. So it's all, when it comes to the bond market, it's based on the mortgage-backed security investors. And if they like what they see in the box of mortgages, or if they don't like what they see in the box of mortgages. And today, the bond market is reacting slightly stronger to the mortgage-backed security pricing from this morning. All right, just slightly, not a lot. You know, it's that time of the year where things don't do a whole lot of moving traditionally, although we've seen, you know, crazier things. But right now, it's pretty stable, not too much movement going on there. All right. Now, I did want to go into inflation because, of course, that's another key indicator when we're talking about mortgages and when we're talking about interest rates moving up or down or staying stable. And inflation came in mixed today, keeping markets cautious but not panicked. And again, breaking down inflation, that's going to come from the PCE. The PCE is where you're going to get inflation from. That's the key indicator. But right now, it came in pretty mixed. Inflation's mixed right now. So markets aren't panicking. Things are still pretty stable, which is why the market was stable today as it pertains to interest rates. Now, going into the Fed and what the Federal Reserve makes of things that are going on right now, keep in mind, whatever the Fed says, lenders bow down to it. They're hanging on the Fed's every word. One sentence can change rates up or down when it comes to what the Fed has to say. And today they said they're watching inflation data closely this week. So they're kind of on the fence, monitoring and seeing how things go. Like we said, inflation is not in a point of panic. It's pretty mixed right now, so there's not too much going on there. So the Fed hasn't really came in and made any strong comments. So lenders are waiting to see what they'll say, as that's a key indicator, one of the bigger indicators when we're talking about your interest rates. All right, that kind of drives what investors are going to do. That in return is based on inflation. And of course, the next indicator, the housing inventory. All right, and housing inventory is very important, because if there's more houses available, that gives the buyer a lot more flexibility. You know, it's all about supply and demand now. If there's a lot of inventory, a lot of supply, you as the buyer, you have the keys. You have the keys to getting things done. And you got a little more flex on the seller. And right now, with housing inventory, is showing steady seasonal trends, with buyers seeing a bit more breathing room than they did earlier this year. So when it comes to housing inventory, just to simplify this so you're aware of these 4 key areas, because I'm never going to get off of it. It's the foundation of the mortgage briefing. And more homes for sale usually means less competition. And less competition means more negotiating power. All right, so keep that in mind. That's why you want to pay attention to housing inventory. These are all things you can check online. I would encourage you to come here. I speak on these 4 every day. It's part of the briefing, so you'll be able to get an update on what's going on as it pertains to the bond market, the Fed, inflation, and housing inventory. I break them down every day. Like I said, I like to set aside a little bit of time of that, because your IPAC and the strength of your IPAC is going to be your protection against any of these changes that you see over here. The stronger your IPAC, the more proof you have against this. It's like it's your protection for any movement going on over here. It's your protection for it. Okay. So just to break down the phrase of the day that I like to go over, we're going to talk about PCE. Because that's inflation, that's the indicator for inflation. But what PCE is the personal consumption expenditure. And that's the Fed's favorite way to measure how expensive everyday stuff is. groceries, gas, clothes, all of it. That's the personal consumption expenditure. And that's what the Fed uses to determine what inflation is. That's their indicator for inflation. All right. And when PCE is high, rates usually go up. When PCE cools down, rates usually come down. And this ties directly into your IPAC score because lenders get more cautious when inflation is high. So your financial picture matters more when we're dealing with what we have that's been going on since COVID is inflation. So having a strong IPAC is going to be imperative, particularly imperative when we're talking about having some protection when you're going into the home buying or refinancing field. When you're looking at expanding your financial portfolio with real estate ownership, you want to make sure you have a rock solid IPAC. That's income, property, assets, and credit. Keeping in mind, if one area of your IPAC is weak, you can still be approved if the other areas are strong. It's a balancing mechanism, almost like a seesaw. All right, so keep that in mind. But as I stated earlier, inflation came in pretty mixed. So right now, there's no market panic around inflation. But just as a rule of thumb, when PCE is high, rates usually go up. All right. So when prices of your everyday consumption items start going up, expect rates to go up. And a big reason behind that is the Fed wants to always encourage home ownership. And one indicator is inflation. Now, when we see a high rise in inflation, that usually is an indicator that the economy is doing well. So if the economy is doing well, interest rates will go up. All right. If inflation's up, what they're saying is the economy is doing well. Now, I know many of you guys are like, hey, man, I'm not doing well. I'm struggling. You know, all these prices going up is bending me over backwards. But I'm with you. All right. I'm just letting you know this is what they use as an indicator. And the Fed has put together a formula with all their economists that work there. And they have said, hey, when we have inflation and prices on your everyday consumptions are going up, then we're raising the rates, baby. We're raising those rates because y'all are doing good. You eating so good. We got to raise the rates on all your everyday consumption items because you guys keep buying it all. So we got to control supply and demand because y'all must be doing great money wise. So we got to slow down all the heavy purchasing by raising prices, you know. And since we got to raise prices on stuff, you guys must be doing great. So we're going to raise the interest rates as well. You know, we got to slow down all this buying all you big rollers are doing. All your high rollers buying everything. That's the picture that the Fed see. That's what the Fed sees. And the Fed is the Federal Reserve for those who may not know. And I'm not talking about the Feds like, you know, the FBI, CIA, what. No, the Federal Reserve, which is the Fed. All right. But that's what they look at. And at the end of the day, it's all about encouraging home ownership because of what I mentioned earlier. That's your gateway to generational income. And that's also the biggest investment most Americans will make. So you want to make sure you are aware that when you're seeing rates rising, it's because they're saying that the prices on your everyday things are rising. Also, you got investors who are liking what they see or not liking what they see in the IPAC. All of these play a role in what rates will do. So keep that in mind. All right. These are things you want to keep in mind. It all goes back to these 4 foundational building blocks, just like your IPACers 4. When it comes to what's going on with the interest rates, they break down into these 4 sections. And of course, inside of these 4 sections, there's a lot more going on. And we'll get to that as we begin to progress. But right now, we want to make it simple, easy, and a way to where you can understand what's going on, because I don't like to talk over folks' head. And one thing I've learned being a mortgage broker for so many years is that there's many people who do not know what's going on this side. And it's because a lot of lenders are not transparent about it. They just want you to sign, buy, and they can keep flipping it into the mortgage-backed security investor market. That's how the banks make their money. They're not traditionally making their money off the interest they charge. Their money is coming from the investors. And the more mortgages they're able to sell off to investors, the more lending opportunities they have to give out more mortgages. So it all is a machine that works together, and I'm here breaking down each part so you're able to understand what's going on with that machine. All right, so what this means for you, and this is some tidbits I want to give you so you're able to be an informed and equipped purchaser or refinancer if you're already in that house, or you're looking to make some more investments in other real estate. If rates are rising, you don't panic, you plan. All right. If inventory is rising, that means you have more choices. All right. If inventory is scarce, you don't. Now, if inflation stays high, lenders get more cautious. So your IPAC is going to matter more. Keep that in mind. All right. Write it down, replay it, whatever you have to do. If inflation stays high, lenders get cautious, so your IPAC matters more. That's why you need to get that IPAC score. That's why you need to get it, man. It's free. Go ahead and answer the questionnaire. We send you a nice little PDF that breaks down where your scores are based on your responses, so it's good for you. All right. Now, with today's earlier sessions of stability, buyers may see small pockets of opportunity to lock a favorable rate before volatility picks up. Now, I'm not giving you mortgage lending advice, even though I am able to do that. I'm just letting you know if you're already in the process and you're working with your mortgage guy now, ask them about this. Now, of course, a lot of mortgage brokers, loan officers, they're going to tell you, oh, man, lock in now. They always want you to lock in. All right. And that's why I'm breaking down what's going on so you know if it's right for you. Because at the end of the day, what's right for you may not be right for someone else. And what's right for someone else may not always be what's right for you. Your individual IPAC is going to determine where you stand, not where somebody else stands. It doesn't matter that your coworker makes the same amount of money. Y'all been on the job about the same amount of time. You may have a late payment that they don't have. You may have a type of credit card that they don't have. Those all play roles in it. You got an American Express where you pay the full balance every month. They may have an American Express where they don't pay the full balance every month. It all depends on your credit profile. Your IPAC matters. And keeping a strong IPAC is what's going to protect you, and you won't have to worry about all of this here as far as you waiting on it in pins and needles. And you can sit back and listen to the daily mortgage briefing and decide if today's the day you're going to start investing or if tomorrow's the day. However, you want to make sure you keep that plan. And with us going into 2026, let's start planning together. Let's start planning together. Get that IPAC score so you can start building out your mortgage readiness plan. So that way, when you are ready to start diving into what rate you qualify for, you know what's going on. You know what's what with everything. And I'm going to keep you informed on the bond market, inflation, what the Fed is saying, what housing inventory is, and what, a good range of the daily rates are. So stay tuned, buckle up. I'm here to help you out. I'm going to make sure you're informed so you can not only think like a loan officer, you can think like an underwriter, and you can think like an economist who's setting up all the different interest rates and breaking down all these fancy numbers. We're going to simplify these things so everybody knows what's going on. So everybody knows what's going on. Because that's part of the thing is they keep that lock, stock, and barrel. But hey, your man's got you. LT's got you. I'm going to make sure you know exactly what's going on and how it pertains to you so you can make a great decision for yourself, for your family, and build that generational wealth that many people are looking for, that many people have a wealth gap they're looking to close. And I'm here to help y'all out with that. All right. So today we want to spotlight the I, which is income in the IPAC. We want to break that down for you. Remember, the I in the IPAC stands for income. And one thing I want folks to know is lenders don't lend to income. They're not lending to, $25 an hour. That's not what they're lending to. They're not looking for that. They lend to income patterns. They lend to income stability. They don't just look at how much you make. They look at how consistent your pay is. Your income story matters just as much as how much the income is. Keep that in mind. All right. Lenders are looking for your ability to repay the loan. So you making $25 an hour this month, but last month and the last couple of years, you've been making $13 an hour. A lender is not going to say, well, today you're making 25 an hour. We're going to qualify you off that. They're going to look at a minimum 2-year history of what your income has been to show stability in how much money you're making, because they want to be able to assess your debt to income ratio, which is your monthly debts divided by your monthly income. They want to be able to get a good assessment of that. All right. So the stability of your income matters when it comes to the I and the IPAC. And just to give you a quick story, because I've worked with all types of income types, and I had a traveling nurse, and her income was set up and based on what contract she could pick up. And she had a contract she picked up and was making 60 some odd dollars an hour. But that contract was for about 90 days. She had another contract. A lot of her other contracts were hovering somewhere around 45 to 50 bucks an hour. And when we did the initial call, I call it my IPAC call. She's like, oh yeah, I make $70 an hour. I'm like, okay, well, that's good. We're going over that. I'm like, all right, well, I go by trust but verify. So I need you to verify how much you're actually making. So I need those pay stubs and I need to see the information. So she sends that over, and I find out that, hey, she's typically making around like $45 an hour. And she only had 3 months where she was making the $70 an hour. So I'm like, that's going to be a little bit of a challenge here. We got to show some stability. But I broke it down to her that, hey, we're not lending to your income. So the $70 an hour is not what we're looking for. What we're looking for is stability of that income. How long have you been making that type of money? And you only made it 90 days out of the last 2 years. So we can't just use the $70 an hour, $60 an hour. I'm sorry. I'm sure I said 70, but we can't use the higher income. We have to use an average of the last 2 years. Now, the good thing was she had been a traveling nurse for more than 2 years, so we were able to show stability. However, we couldn't just use the highest that she's made, and some folks are not aware of that. But she was very understanding. I broke it down to her. We had to structure some things to get the DTI back in check and pay off some things on the credit report. So her monthly debt came down, and then we had to restructure what her housing price was going to be so we can have an approvable loan. But it took me explaining that, because some folks are like, well, hey, man, I make $70 an hour, so I'm capable of making that. So I want to get a loan on that amount. And it's like, well, lenders aren't just looking for a pay stub or a contract that showed that at one point you made that. We have to look at your consistency of getting that, because it's about your ability to repay the loan. And 30 years is a long time. Anything could happen. But banks don't want to send, you got to remember, they don't want to put a shaky mortgage in that mortgage-backed security box. That's going to scare investors off. They got to make sure the investors see a lot of strong IPACs in those mortgages that's in that box. They got to see a whole lot of strong IPACs. And if they don't see a lot of strong IPACs, sorry guys, if they don't see a lot of strong IPACs, then that's going to change the game when it comes to rates. It's going to scare investors off. And that's the whole thing that we don't want. We don't want investors scared off when it comes to that. But that's my quick story for the day, because a lot of folks need to understand that, hey, when we're talking about your IPAC and the importance of the IPAC, then this kind of ties all of that in. And income is one of the biggest reasons I deny loans. One of the biggest reasons is based on your debt to income ratio, or your gaps in employment, or your length of employment. Somebody gets a new job and they're making more money than they did before, but it's in a whole different industry. They've only been there a couple months, and the first thing they're looking at is buying a house. But if we can't show the stability there, then we may not be able to prove it, because we're looking at your income stability, your pattern of receiving income. And we're not just looking at how much income you have. We're also looking at your debt to income ratio and the stability there. So all of those play a role in the I of the IPAC. But I'll tell you, I've denied more folks for income than I have for their credit score. I have. Income has been a deal breaker. for a lot of profiles I've dealt with. And many folks, the first thing they tell me about is a credit score. That's all they want to talk about. I got a 680, I got a 720. And it's like, okay, you can have a 720, but if your debt to income ratio is 83%, that's going to be quite the challenge to get a new house. You're still pretty much check to check because the debt to income ratio isn't even breaking down your daily household expenses, your personal consumption expenditure. That's not included in your DTI. So if you're at 82% just based on your income and what's on your credit report, imagine if we included your personal consumptions. You'd be well over 100. We probably find out you're living off your credit card, which a lot of folks are. So that's why it's important to strengthen that IPAC. All right, and I said this be the daily brief, and I'm sorry if I'm a little long-winded. I got a lot to unpack. We're going to be unpacking stuff every day. So lock in with your boy. Check us out. Please like, subscribe, follow, share this. There's somebody near you, somebody in your degrees of separation that needs to hear this too. Don't keep me a secret. Show me to other people. They need to tap in with this daily mortgage brief, and I'm giving this game out for free every day. Hop in and get some of this. Replay it. You got holiday season coming up. Y'all need to be sharing this with your folks, sharing it with your family. Everybody needs a piece of this. Now, I just wanted to go over some do's and don'ts, and then we'll go over the action step for the day, and I'll let you on your way. But as far as the do's, make sure you do this. Keep your pay stubs, keep your W-2s, and keep any bonus or overtime documents. We're in a digital era, man. I know some of y'all get direct deposits and you're like, I don't get a pay stub. They have to still give you a pay stub, even if it's digitally. Download that, save it on your Google Drive, Apple Drive, what have you, your iCloud, and also put it on a thumb drive. Because you may sign in one day or something may happen where you're locked out of your account. You don't want all your documents just in the cloud. Make sure you got it on a thumb drive too. Have it nice and neat in some folders that you can set up digitally. Imagine we're in an era where you don't have to have a file cabinet full of a bunch of papers that could get burned up, get wet, damaged. You can actually just keep it on a thumb drive. Keep it downloaded in the cloud and keep it organized. Remember, the biggest investment you'll make in your life will be home ownership. Don't mess around with your IPAC. Always keep that thing strong, man. And the I in IPAC is income. You should know what's going on with your pay stubs, with your W-2s, with your tax returns. Any bonus documentation, if your job sends you an email about your pay raise, bonus, commissions, those things need to be downloaded and saved in a special folder on a thumb drive and in your cloud. This is important. You want to be one of the strong IPACs in that box of mortgages, not one of the weak ones that investors don't want anything to do with. Don't be the reason that rates go up. Don't you be that person. All right? Now, don't switch jobs mid-approval unless we talk strategy first. Do not switch jobs midway through an approval. Don't do that. I've had that happen, and it's an uncomfortable call to tell somebody who was approved, and then they switch jobs in a completely different industry, and you have to tell them that we can't do the loan anymore. And they were ready to buy a house. I've had folks who have moved out of their house, staying temporarily with family. Then they switch jobs for a better opportunity. However, some things changed on that debt to income ratio, and we weren't able to get the house. They didn't have stability. They couldn't show a pattern of them receiving that type of income. So the underwriters are looking at it like, hey, we don't know if this is something that'll keep up. So don't switch jobs mid-approval. If you can't wait until you get the house to get the new job, get the job first. All right? Speak with a mortgage professional. If you want to reach out to me, you can email me. It's in the bio. And find out, hey, am I able to get approved? Would this be a problem? And I'll see if we can work something out. All right? Because sometimes it may not be a problem at all. If you're still in the same industry, you've been in there more than 2 years, maybe fine. But to be on the safe side, don't switch jobs mid-approval. Just don't do it. It's not a good idea. Do it like, just don't do it. Don't do it. Just don't do it. All right, now as far as today's action step, I love to break down the action steps for every day because this helps propel you as we get into 2026. So you can have a plan and you can have strategy, not stress on your plate for 2026. Take 60 seconds today and look at your last 2 months pay stubs. All right, look at your last 2 months of income. If anything has changed, new job, bonus, overtime, make a note of it. All right? This helps create and tell a clean story to the lender. So just look at your last 2 months. I'm not asking to look at the last 2 years. Some of my analytical folks out there may do it. But I'm just asking for you to look at the last 2 months of pay stubs, your last 2 months of income if you don't get pay stubs, if you're self-employed. If there's been any changes, make note of it. That way, that's something you can tell the lender. Because I'm going to tell you this. If there have been any changes in your type of employment, if there have been any changes in your income, bonuses, etc., the lender is going to ask you for a letter of explanation that you're going to have to write and sign and send to them. And then they'll use that to determine stability, your income pattern. If you've already made a note of it, I got a promotion July 1st, 2025. I now make this. You already got it. Boom, here you go. Here you go. And you don't have anything holding up your process, because that's one of the biggest things is lenders say we're going to close at this date. We don't close at this date. Well, if you already got your ducks in a row and they're asking for a letter explanation, you can just email it to them right then or upload it on your profile right then. You're good to go. You're not holding up the process. You're not going back through your notes to find out, well, when did I get that promotion? Take 60 seconds. It won't take that long. You know if you got a promotion in the last couple of months. Look and see if there's anything going on. And if you already know for a fact, hey, man, in March I got promoted. I was working in this department. Now I'm in this department making this much. Go ahead and make a note of that now. You can just type that real quick. You can speech to talk that, type that right into Microsoft Word or what have you, Google Docs. It'll type it in there, save. Done. Done. You want to tell a picture. You want that strong IPAC. You want a strong IPAC. You always want that. This is the biggest investment you'll ever make. Don't play around with it. Every little step matters. Just take 60 seconds to do that. Now, again, if you want to know how your IPAC stacks up today, take the free IPAC score at theconstructivehouse.com. I want to thank y'all for joining today's daily mortgage briefing. Remember, your strategy, your strategy is what matters. You don't need perfect circumstances to buy a home. You need a strong IPAC strategy. You need the right information, and I'm here to help you out. If you want help reviewing your IPAC score or planning for your approval or pre-approval, the links are in the description. I hope y'all have a constructive day. Thanks for tuning in.